Hello everyone, welcome to the Money Club series. I'm your host, Zar Azmi, and I'm joined by my delicious shish kebab.
Shish kebab, oh my
Sam
God.
Eljaban, how are you? If you were a kebab, what one would you be?
I think I'd be a lamb souvlaki.
Really?
Yeah, I don't know why.
Really?
What would you be?
I would think you'd be like a chicken thigh, you know?
Chicken
You know
thigh.
those chicken thigh ones?
But what spice? Like, what am I marinated in?
I don't know, you tell me. You know the recipes. I'd be a big round ball of falafel.
I don't even know what to say.
I'm trying to go vegan, right? Because falafel's vegetarian, right?
Healthy. Cut down on your meat.
How have you been, Sam? How is the adrenaline rush of accounting going for you?
It wore off about 10 years ago. There's not much adrenaline in accounting, but it can be fun at times.
Yeah.
This is our busy time in terms of some tax planning we help clients.
Why is it our busy time at the moment?
You know what? I'll actually clarify that statement. We're always fucking busy. We're always busy. I think clients who use an accountant will understand that we take a long time to get back to you. I don't, so if you need help, ask me. But generally speaking, accountants are quite slow because they're so busy. Mm-hmm. We're always busy. And a lot of people think that from July to October, when people get their group certificates, we're busy then. We are, but it continues up until now, June, the following year. Why? Because everyone's different. You have a business, other people are working, right? People that are working usually want a tax refund. So they're the guys coming from July to October. But people in business like yourself, you still have BASs to do. And because you're in business and you have the ability to sort of delay your tax payment because you're not on wages being withheld constantly through your payslip, you can delay your tax payment up till May next year or in the following year. So
you're always busy.
Yeah.
So you're always busy. So it's, you know, you've got that even spread. And our listeners, I think, you know, you could probably split it up half and half. Half would probably be employees and the other half would be business owners. So it's a good thing because it gives you that even spread over the year. But especially now, being June. End the last month of the financial year. Yep. Everyone's, you know, rushing to, you know, get things done. And for our listeners that are unsure of what they need to do, we've come up with a 10-point or 10 tips of what to do before June 30. Yep. It's always 10 with us.
Yeah, that's it.
You know, it's a very round, good number for us.
That's it.
But if you can do these 10 things before June 30, then, you know, you're going to put yourself in a good position tax-wise. We'd like to start this with a disclaimer saying this is not financial advice. It's purely just financial education and from our experience. Yep. We do, you know, advise you guys to go and seek out your own professional sort of advice. So let's jump in, Sam. What's the first tip?
Let's do it. Being an accountant, it's a very accounting-focused tip. Be organised. I've had so many issues with clients coming to me, say before 30 June, after 30 June, whenever it is, just with no organisation of their files. They don't know their expenses. They don't know their income. They're just not keeping up to date with their records. That is a big inefficiency from their end, from a tax point of view, because if they're missing any expenses and things that might help them, they're not going to get the tax benefit from it. So I would say first big tip is stay on top of your records, your affairs, keep records throughout the year. There are some apps available for you. So I did have a look on the ATO website. There's a thing called My Deductions app. So just say you're working, it's more focused at workers. You can download this app, and whenever you incur an expense relating to your work, you take a photo of it and store it in this app.
That's pretty cool.
You can send it to me at the end of the year, go, here's all my stuff. Bang.
That's pretty cool because, you know, getting paper receipts and everything, it's very annoying, right? It's very annoying. So that's a really good tip, actually, to be organised. Because I'm actually guilty of this, Sam. Like, and you've seen, you know, a lot of my paperwork and how unorganised I am. Yeah. It's because I'm focused on running my business. And, you know, it is a very mundane task to, you know,
it's boring.
Bookkeeping and all of that sort of thing. And it's very boring, right? So I think, though, it's an investment. Because if you don't get organised, then when it comes tax time, you're, you know, scrambling to get all of this stuff together. And you want it to be as accurate as possible, because if you get an audit, like you need to make sure you can prove everything that you're claiming.
Very good point. So a lot of clients would come to me trying to put in whatever they can without evidence. But really, at the end of the day, if you get audited, the ATO want to see evidence for every single thing you've claimed. There's some minor thresholds you can claim without evidence. It's amounting to like $500. That's it. So unless you don't have receipts and evidence for something above $500, you're going to be in trouble if they look at you. So
that app is super critical if you are an unorganized person, because this technology now is allowing us to, think about it, 20, 30 years ago we never had this, right? You'd have to keep a shoebox.
I still have clients like that with shoeboxes.
Old school.
Oh, mate.
Old school.
Terrible.
But at least they're organised.
They got the records, but what happens there is that it takes me a lot more time to look through their stuff. Yes. And they don't even know what's going on. Yes. And they ask me questions about their affairs, and time is taken, and it can add to a bill.
Well, you have to charge.
That's it.
Right? You have to charge for your time.
The more organised you are, the more you can give me in terms of everything you've spent and orderly fashion, the less cost you'll have to pay the accountant, and the more deductions you'll get because you've got them ready.
And I guess going on to the next point with that is I just recently employed a bookkeeper, believe it or not. Like, I should have done it like 3 or 4 years ago. But we've always done our own bookkeeping. Yep. And, we consider ourselves quite organised, but it was a really hard transition because we're sort of letting go of this control and letting someone else sort of organise the books and reconcile and all of that sort of thing. But number one, it's saved us time. Number two, it's saving our accountants time, right? Yeah. Who charge us so much. You're so expensive, Sam. But it also gets done very professionally, and everything's organised. The BASs are done. They're basically lodged on time, and there's no discrepancies, right? So I think when you get into business, for example, getting a bookkeeper can really help you get organised.
100%. Any client that comes to me starting a business, I say get a bookkeeper as soon as you can. They might dabble in it for a limited time just to get things up and running, but once they're making a bit of money, get one.
I think it puts people off if they have to spend money on a bookkeeper. Like they charge $55, $70 an hour, and they might spend initially 10 hours a week on your file, but eventually it's only just maintenance, and you might only spend $100 a week or whatever it is on a bookkeeper. And I think it's well worth the money, so you don't have to think about it, and you can go and focus on making money.
And if they are caught up on the dollar kind of thing, just think, if whatever business you're in, you're making $150 an hour, and you only have to pay this guy $50. I'd rather keep doing what I'm doing for $150 and pay someone else for $50.
That's right.
So pay the guy, let him do it. You can hammer him, get everything done how you want, and everything's organised.
But in the beginning stages, Excel spreadsheets, this app that you're talking about, you can do it yourself. But I guess develop that habit really, really early. With these topics, these tips, right? We've got 10 of them. How we're doing it is, we're going one for one. So that first one was Sam's tip, and then the second one will be mine, and then the third one will be Sam's. So this is going to be my tip. My tip is to go out and buy the most expensive commercial vehicle, as in a truck, as you can. A lot of our listeners know that I have my own truck, which I've written off on tax. So I've just had a friend who's just bought a Ford F-150, those big things, those big Raptors. So not the Australian Raptors. These are the ones
import.
The imported ones. I think
it cost. They look like a truck.
I think it cost him about $250,000, right? But he can write that whole thing off.
Exactly. Yes, it's a really good play. The government's brought in. It's an extension. I'm going to get technical about it. The instant asset write-off. Everyone probably knows about that in business. So this is applying to people in business only. So if you're an employee, don't go and buy a fucking truck. You're not going to claim it as a deduction. But if you're in business, they've extended this instant asset write-off. They've called it something else, which has confused a lot of people, but it's now called temporary full expensing, and it's extended to 30 June 2022. So if you don't make it in time for 30 June, which a lot of people aren't because of delays in imports and all that kind of stuff, you're not going to miss out because you can apply it to next year's tax return. So it's still available, this big write-off that you're talking about.
For another year.
For another year.
Yeah.
It's called something else now, which has scared a few people trying to rush and buy something. So don't stress too much. You can still apply it next year.
So for our business owner listeners, right, if you've got $1 million worth of profit for the year and you've gone out and bought this $250,000 Ford Raptor, just like my mate has, what does that do to your profit?
So your profit will drop to $750K.
Yeah.
And the tax saving by buying it is going to be 30% on 250, which is about 75.
Generally speaking.
75 grand.
Yeah.
You'll have a tax saving of.
Yeah.
Okay, so it's quite lucrative. And what people are doing to save their cash to deploy elsewhere, they'll finance this vehicle. So sometimes clients aren't even paying for this car and they're saving 75 grand. They've got it on a loan. And so that's a really good cash flow play with a tax benefit.
Yes, and we're not big on telling people to go out and get that bad debt, right? But if you are an established business, you're turning over, in excess of $1 million, for example, and you've got assets behind you and enough good debt, you're quite well to do. I think getting the finance is actually a smart move because money's cheap. Money's cheap on borrowing for cars and or equipment.
What is it now? Like 5%?
It's like you can get 4%.
4%.
Yeah. It's super cheap.
Yep.
But if you can actually maintain that and do it, I think it's great because it works pretty much the same as property, right? Where you get to depreciate the whole amount on the whole leveraged amount, and it's the same as equipment finance. So if it's bringing value to your business, I know my vehicles have brought a lot of value to my business, we got a lot of brand exposure and marketing through them. I've got sign writing on mine and personalized number plates. So it's a promo vehicle, really. So I've gotten a very good return on my investment there. I've bought all of mine outright, but, I think I probably should finance them when you think about it, right? Get something more expensive like that Raptor, take advantage of that $250,000 write-off, but I haven't really actually bought it,
the money.
right? I haven't spent it.
And think about return on money as well. So you'd leverage now because rates are low, because if you have that $300K in your business and you're buying stock or flipping stock, whatever you're doing in your business, you're probably making 30% on that money. Where you can borrow the money at 4%, I'd rather do that. Borrow at 4%, the 300K, and make 30% on my 300K in my business. I'm up 26%.
Yeah, so you can make your money work a lot harder for you. And this is where the Money Club's about tax and wealth, right? It's about saving money, and utilizing your money to grow. I guess for those guys out there who own businesses and they don't have $250,000 to spend or they don't want to get the finance because they're not in that position, there are other creative ways you can deduct expenses, and we're still on the topic of writing expenses off. So for example, if you've got a really creative accountant and he's willing to really push the envelope for you, then these are the sort of things that you should do. So, for example, I've bought this Ralph Lauren shirt specifically for this podcast, right? Specifically for this podcast. Now, I'm going to dispense this shirt afterwards. I'm not going to wear it ever again. I'm actually going to give it to Vinnie's, which is a donation to charity. So I'm going to put you on the spot here, Sam, and ask you, can I claim this? It's purely for this business podcast, right, which is part of my work. I'm not going to wear it ever again. There's no personal use out of this Ralph Lauren. I think it cost me $100. And then I'm going to go give it to Vinnie's, which is a donation. Now, there's a double whammy. If your accountant says, right, that you can't claim this as a deduction, you need a new accountant.
We might have to fight ATO, but I'm happy to fight for you.
There you go, people. There you go. There you go. Ralph Lauren's going to be packed.
ATO will probably knock on our door soon, right?
But you've got to get creative, right? For example, if you can prove that, if you can prove that you're using something for business purposes, that's the whole point. If you can prove it, and it's business purposes only, and I just use this as a fun example, right? And there's no personal use out of it, then you can write it off.
That's it,
right?
That ATO says there has to be a connection to income, so theoretically, yes, that would play in that space.
There you go, people. Louis Vuitton, Ralph Lauren.
I just touching on this instant asset write-off just quickly before we move on. We talked about the commercial vehicle. I just want to tell people if they're going to buy a passenger vehicle, the cap you can claim is 58k. So don't go buy 200 grand.
Yes, we did say
AMG.
Commercial.
Just want to clarify.
The very good point, Sam. So the reason why my mate could do the Raptor, it's a commercial vehicle, it's a truck. I think commercial vehicles are classified as something that can tow.
It's a payload
over a ton or something like that.
Payload of a ton or a larger vehicle with more passengers.
That's right. So for example, I just bought my wife a new SUV. I could only write off 58,000.
58K,
yeah.
So
Which is still good.
Still good.
It's still a good deduction.
Still beneficial.
Yeah, it's better than nothing.
Yeah, don't go buy a Lamborghini thinking you can claim it because you can't.
Well, you can, 58,000.
Yeah, but you can. True. You can't claim the whole amount.
For our Lambo fans out there, it's still possible.
Do it if you want. Yeah, correct.
Okay, Sam's number three tip, his boring tip. What is this one?
Boring one, but it will help you a lot. This is very accounting based. Delay income and prepay expenses. Okay,
so let's start with the first one. Delay income. What does that mean?
When I meet clients at this time of year, it's all about tax planning for 30 June, which is what we're talking about really in general here. One of the strategies we can do is play with your income and play with your expenses in terms of if you have some jobs in the work, so you're going to be able to invoice them soon and receive payment, delay that money. Don't receive it yet, receive it in July. Why? If you realize the money now, if you receive debtors now, like debtors payments, accounts receivable now, or if you invoice someone and they pay you before 30 June, all of that income is taxable in this financial year, 2021. 2021 tax returns are due 2022. Okay, so you have to pay your tax on it then. If you can delay that till July, this income could be 100 grand, depending what you're doing, what type of industry you're in. If you can delay that till July, you're now realizing the income in 2022. 2022 taxes aren't due till 2023. So you're effectively delaying the tax payable on the income for a whole year. And if you have substantial profits, that could be, 30 grand, 60 grand, whatever that tax bill could be, that you now still have in your pocket for an extra year, which can be quite effective.
Yeah, because you want more money in your pocket now than so it's sort of you're deferring
of tax.
Your taxes,
exactly.
Right? So to give our listeners a little bit of clarity on that, I'll use myself as an example because that people can get lost in that and think, okay, what does that all mean, right? So to give it an example, let's take myself as an example. Right now, my business account has $0 in it, and it has been like that for the last 2 weeks. Now, my support staff are telling me, when can I invoice? When can I invoice? And I'm like, hold off, right? Because people that aren't in a rush to pay you, really, at the end of the day, they will like to delay paying you. They're still going to pay, but they don't mind, right? And then they say to me, well, Zah, how do we pay for our overheads? We've got marketing costs, we've got to pay rent and all of that. I said, put it on the Amex.
Yep.
Right? Put it on the Amex. So now my Amex bill has all of these business. This is all business expenses, right? Yep. Business expenses on it. You've got 20, 30, 40. It just keeps going, right? But I get to claim those expenses because I paid for them before June 30, but I haven't received any income. Now, as soon as July 1st comes around, all of a sudden, everyone's going to get bombarded with these invoices, right? And that is a really good example of delaying income, prepaying those expenses, even if you have to get it on credit, right? Because you can claim those deductions, which will reduce your tax bill, right? And then you can also delay that income, which defers that tax. It's a really good tip.
What you're effectively doing is squeezing your profit. Reducing the income, increasing expenses, so your profit's really getting squeezed, which is very effective. Who'd you learn that off?
The best in the business. My little shish kebab.
Touching on the expenses part again, just quickly to wrap this one up. The prepaying of expenses, you explained how you did it with the Amex, which is good. Types of expenses, just so people can think about what they could do, is anything consumable in your business. If you're in an office sort of environment, you can prepay leases for up to 12 months. So for whatever reason, just say you had a mad year this year and you think maybe things will slow down next year, you could prepay a lease for up to 12 months in advance. Any types of consumables within the office, paper, ink, all that kind of stuff, marketing materials, you can prepay all of this. Buy it in bulk in lieu of all the activity to come to really squeeze that profit down. One tip for investors as well, property investors, slightly off topic, but it's a prepaying expense. If, for example, you sold a property, we don't advocate selling, we always want to hold, but sometimes people will realise a gain or have a really good income year in business and all that kind of stuff. If you have investment properties, and if those investment properties have fixed rate loans, you're able to prepay interest on that fixed rate loan. So getting the interest deduction for 2022 claimed in 2021. Or the current year you're in. So if you have a one-off year of great income and you think next year is going to be slower, you can prepay interest on investment loans
to reduce your income
this year. So it's sort of like if you think if you lost your job or business is going out of business next year, you can pull back that interest claim now.
Yeah. So foreseeing the future.
Foreseeing the future. So and you could even keep playing catch up with that, keep prepaying along the way, sort of thing. Yeah. So little trick there as well.
Very good, Sam. Very good. Now, for just quickly, for our employee listeners, this delaying income, prepaying expenses, can it help them?
Very difficult to do. Yeah. Employees are really...
You're quite limited, aren't they?
You're like the beast of burden in an employee situation. One, your tax is taken before you see it. Two, you're limited on your deductions and any type of creativity in terms of income and all that kind of thing. Which is why we really, if you're an employee, you're really limited to your tax planning with super and investment properties. There's not much really outside that scope for effective tax planning. Yeah,
okay, so being an employee is not necessarily a bad thing, but when it comes to tax planning, you're quite limited with what you can do, and that's why we always say, if you're an employee and you're driven to succeed financially, maybe strive to become self-employed and run your own business, because then it opens up to a lot more options.
If you are very successful in the employee space, which is good and good on you, you'll pay a lot of tax. You can't defer any of this income expenses, but you have to rely on super and investment properties to reduce your tax.
I'll just add on that, you're still a bitch. So try and run your own business if you can. Number 4.
What is it, mate? What is it?
This is Czar's one, and it's called the 10-year acquisition strategy.
Amazing.
And for those people who don't know what the 10-year acquisition strategy, it means 10 properties in 10 years through Luxland.
Yes.
And the reason why is because property has, and you're not going to buy 10 properties before June 30, but the reason why we say, have that mindset of accumulating as many assets as possible, because those properties they provide so many deductions. You've got deductions through the expenses, or your interest repayments, the depreciation, and like we just mentioned earlier, you actually get to claim on the full amount, not the equity that you put in. So, for example, if we're talking a $500,000 property and we put $100,000 in terms of our deposit down, we actually get to claim the amount of the $500,000 amount, the financed amount. And that's the beauty of property because of that leverage, right? And I think the more properties you have, and that's why we spruik the 10-year acquisition strategy, because it's about buying 10 properties in 10 years. Buy as many as you can, right? And this is the problem. A lot of people buy 1, they buy 2. I think the majority of property investors, they just stop at 1. They buy the home that they live in, and they just buy 1. And that's, I think, makes up 2 million property investors in Australia. It's less than 1% of property investors own 6 or more, right? But that 1% that own 6 or more, right, which I think works out to be about 20,000 people, those people get unbelievable tax deductions. Some of them don't even pay income tax because they have that many tax breaks through their property portfolio, which is completely passive.
Yeah, I've seen clients in that situation. They've had about 10 to 12 properties. They were on 150K salaries each, and through the property investments, depreciation, all that kind of stuff, they actually had zero income.
Wow.
So they were getting full tax refunds on 150K, which is like 35 grand, 40 grand, something like that. So it's a very good play. Just make sure when you're picking the properties, obviously you follow your fundamentals. You want potentially net cash flow positive stuff, but with depreciation will create your loss, so you're not out of pocket at all, but you're getting refunds. It goes back to what we talked about in the previous podcast. Remember the blueprint we talked about, Money Club blueprint?
Yes.
Property is suitable for anyone, whether you're an employee or in business whatever you're doing, it's going to be something that creates wealth for you if you pick wisely. And with the deductions available, will reduce your income.
So this tip here, which is, because unlike the last tip that you gave, Sam, where you forgot about the employees, right?
Yes, yeah.
I'm actually now
more inclusive.
going into bat for them,
I was
right?
discriminating, sorry. I was discriminating.
But this is a really good one for employees. Like those clients that you're talking about who are on, 150 grand each a year in income, which is a pretty good employee income, which a lot of our listeners are on that type of money, 150 grand. Yeah. If you've got 10 properties and you're earning that income tax-free, then it ain't so bad being an employee anymore, correct?
Yeah, you're tapping into the tax. So Scott Morrison's helping fund your property portfolio.
Good old ScoMo.
Which is good. I'll give you just a quick example with numbers, just so we can visualize it quickly before we move on. If you're on a 100K salary, you're paying 25 grand in tax. You're taking away 75K net, right? If you were to get one property, and with the numbers we've done on some properties lately for clients, you'll be net cash flow positive closely. So you're not paying any money out, but then you'll get this deduction for depreciation on a new build of about 15 grand, depending on average. So you're showing a 15 grand loss in your tax return.
Which brings 100,000 down to 85.
So if you do that 3 times, you've now got 45K. You've got 3 properties.
3 times $15,000 depreciation. So you've got $45,000 reduction in your income. So now we're at $55,000.
55K.
Yeah.
And if you were to then lodge a tax return with that rental property loss, you're going to get a tax rebate of about 14 grand. 14 grand refund of the 25 you've paid. So you've only really paid 11 grand.
Wow.
For your salary, but you haven't lost any money out of pocket for the rental. It's just depreciation's reduced.
And all of a sudden, it's great to be an employee, right?
3 properties, say 15 grand. If you add another 1 or 2, you're pretty much getting all your tax back.
But you've got to do the work, guys. Like it's not easy. Like you've got to buy those assets. It's not easy. You would know, Sam.
We deal with
right?
people. It's very hard to do.
Like it is very hard to do. But if you can get there, then all of a sudden, it doesn't matter if you've got a business or you've got a job or whatever it is, right? And you don't even need to be on a massive income. You can take advantage of these tax breaks.
Yep.
What's the next one, Sam? Sam's boring tip.
It's at least it's inclusive. So it's wrapping up everyone, business or employee. Super. We've talked about it before. What is it?
So many people hate super.
What is it, mate? I love super.
Yeah, I know you do. I know
you do too.
You love some really weird shit.
I love super anyway. Yeah. It's amazing. But what is it? It's a forced savings. It's a forced retirement savings plan the government enforced to us. We have to pay it. If you're in business, you have to pay yourself. If you're taking a wage, you have to pay it to yourself.
They're looking at increasing it, correct?
Yeah, it's going up. So it's currently 9.5%.
Yeah.
That's standard. You have to pay. Other organisations to try and attract people will pay you more. So it's not standard 9.5. But it's going to go up, I think, to 10% and then continue going up down the track.
And that's purely because people aren't investing into their futures, and the government's very worried because we've got this ageing population, and people are going to retire at 65 and still have another 30, 40 years to live, and they're going to need this money. Like I was really disappointed to hear a lot of people withdrawing from their super and buying depreciating assets like cars and stuff like that. It's the one thing, especially a lot of those people who are drawing from that super, they don't have any other asset. It's generally people's only asset. And if you're taking that early and not letting it compound in the background, you really are shooting yourself in the foot. I think, getting back on point with your point of super, we should be adding to it, not taking it away. And why should we be adding to it, Sam?
At the end of the day, once you stop working and retire, whatever that balance is in super, just take a round number, for example, $1 million. Hopefully we get to that level. That balance within your super fund will become tax-free. What that means is that $1 million, just say it's invested at 7%, will make you $70,000 in your super fund, and it won't get taxed on that money. And then you, as the member of the fund, it's your super fund, you then take that amount tax-free to yourself as a pension, and that equates to about 100 grand salary if it was taxed. So what it is, it's the holy grail of the tax system in Australia, and the ATO and the government give incentives to people to actually boost it, like you said. It's something that's going to benefit you down the track, and the ATO allows you some concessions. So you're allowed to deposit up to 25K a year. It's indexed, it's going to go up moving forward. 25K in one financial year as a deductible contribution. That includes your super guarantee on salary. So if you're working on 100 grand and you're getting 10 grand super paid to you already, that 25K is reduced by 10K to 15K. You are able to make a contribution to super of that difference. Doesn't have to be that difference, but it can be up to that difference. To super and get a tax deduction for it.
So for our listeners, to give you a bit of an example, I had to go and check how much money I contributed to super this financial year.
Yep.
I needed to figure out, okay, what's the gap of that $25,000, because I want to, for my wife and myself, the gap, I want to make it up to 25 each, because I think it's such a tax effective play. But at the same time, I have an SMSF, which stands for Self-Managed Super Fund, which invests in property, right? But that's something our listeners can consider if you want to supercharge your super. But that investment is exactly the same as me investing in the 10-year acquisition strategy. It just means that, okay, I can't take advantage of it or personal advantage of it until I'm 65. But the properties I'm buying in my personal name or my family trust now, like, that's a buy and hold strategy for then as well.
Anyway.
So it's the same thing. A lot of people have these super balances and the ability to give tax-free contributions or tax-deductible contribution, and are able to buy more property or are able to, do other investments. So going back to your example of the, let's say, 7.5% return on $1 million, which is 75 grand a year. Let's say it's tax-free, $1,500 a week, tax-free in the pocket. Mate, to get that from a business or a job, right? Like you're working very, very hard.
Yeah.
So our advice, not advice, but from our experience, we think that contributing to your super will really pay dividends in the future.
And one thing I like to tell clients is it's not like you're buying a TV, a projector, a laptop. It's not an expense. You're just simply transferring what cash you have now here to a super account you'll get later, and you're getting a tax deduction for it. It's not even an expense. You're shifting money from one account to another account or your super account. Can't touch it now, but you get a deduction, which is good.
Moving on from that boring tip.
Very boring, yes.
Now, Czar's tip is to buy and hold and never sell.
Why? Why would you do that?
Look, we've all seen the TV shows of the flip and flop and house flipper and all of that stuff, and we all get sort of sucked into it and very romantic with the idea of being able to rehab or renovate a property, bring it back to life, and then put it on the market and have 100 people in the street at an auction.
Very exciting.
It's very exciting, right? And there's a lot of money to be made in it. But the problem is that you're number one, you're left with cash at the end of the day, not an asset. Right? And cash is trash, as we know. But also, you're going to get hit with a really big CGT bill, and you lose all of those tax-deductible expenses that property allows you. And so the thing is, sometimes people can't afford to hold on to them because it might be negative cash flow. It could be burning a hole in their pocket. It could be going down in value. Like, there's so many different reasons why people sell, right? But generally speaking, if you can buy and hold, maintain those deductions, right? Potentially refinance when the property goes up in value, tap into that tax-free equity, which is debt, right? But then go and use that money for whatever you need to use it for. Hopefully it's to keep investing. I think that's a much better strategy. You're going to get you're going to be in a much better tax position, and you're going to build more wealth, generally speaking.
Yeah, and if you look, like you said, you're going to be left with cash. And what are you going to do with the cash? You're probably going to invest it again.
Yeah.
So you might as well just keep
You know what's funny? This number 6 tip, the buy and hold tip, is actually quite boring because a lot of people want the excitement of selling and getting the cash and then going out and buying the Lamborghini and all the bullshit, right? But really what we want to do is the boring strategy of buy and hold, never sell, right? You know, avoid that CGT bill, because you know we want to hold on to these assets and let them compound over time.
We'll talk money because that'll relate to a lot of people. So just say you had a property bought for 600k, you sold it for 700k, or just say it's worth 700K.
Which I've done. I've actually done.
And you copped some shit, right? So just say you bought something 600, it's now worth say 700. You haven't sold it yet, but these are the two scenarios. You can refinance and maybe tap into equity, get about 80 grand to do another one, right? Hopefully it goes up as well. If you then go, oh, now I want to sell it for whatever reason, if you sell it with 100k gain, how the numbers fall from a tax perspective. So the 100k capital gain, you get a discount to 50 grand, okay? And then you're taxed on 50 grand if you've held it for more than 12 months. And we'll just take a highest marginal tax rate, you'll pay about 25 grand, 24 grand in tax on a 100k gain, all right? But what else do you cop when you sell a property? Sales commission. What is that usually? 2%?
2%.
2% on 700k is 14 grand.
Marketing, another 1%.
Another 1%. That's I didn't put that into my numbers, but I'll just show you my numbers first. So if you got 100 grand, you sold it for the gain, and you have to pay 25k tax, capital gains tax, 14 grand sales commission, and legals and stuff of 2 grand. That's
you got your legals as well.
$41,000.
Yeah.
Taken from 100 grand is 59 you're left with. So it really hammers you. When you can just take the equity of 80 grand.
And what the fuck are you going to do with the money? You're going to reinvest it anyway.
Probably buy like a Pajero.
But really, like if you're smart, you're going to want to invest that money anyway.
If you're investing in property.
I've done this before upon bad advice from a banker, and you know it's funny because he should have just told me to refinance it because
he would have made more money.
He would have kept the business,
yeah,
right?
Okay.
So anyway, I sold it. I ended up with this cash, which I had to pay so much tax on. And then I was like, okay, well, I've got to reinvest it again. And I'm like, what an idiot. I should have just refinanced and held on to that property. That property today is worth like $1 million. You know, I sold it for like $565 or something like that.
Wow. So you lost that potential gain, but then you bought another property, didn't you? And you got new stamp duty.
Look, the reason behind it was I needed the money to put into a development. So I did utilise the cash quite well. But there were other strategies to be able to do that development and also hold on to that property. Lucky for me, you know, like it's not millions of dollars, and it's also something that happened very early on in my acquisition strategy. So I felt the pain very early, and now I know not to do that anymore. So it's a lesson learned, and that's what we try and teach our clients.
Yeah, if you come on board, you get these lessons.
This one's very, very boring. Warning to our listeners, Sam's going to give you a very boring tip. What is it, Sam?
Think about asset protection and tax minimisation. That's pretty exciting when you think about it. Do you want to be sued and lose all your shit?
No, I don't.
Then that's why you have to listen to this stuff.
It wouldn't be boring then, would it?
We won't spend too much time on it, but
it's important.
If you're it's more so if you're in business. Employees, their risk profile, they don't have too much risk. If you have properties and things like that, maybe you're delving into a risk area because you have tenants now and things like that, and there are some structures you can use to help mitigate risk. But this is more so for business people again, only because I know a lot of people are in business now with COVID hammering jobs, people going online, doing all this kind of stuff. Really, you want to be looking at different types of structures when it comes to investing and business. I'll just quickly go through the basic ones because a lot of people probably don't even know the types of structures you can deploy in your affairs. You have your individual situation, right? So you can invest in your own name. You can start a business in your own name as a sole trader. If you do that route, you have no protection and you're really restricted in your tax planning because all the money goes to you. Okay, and if something happens in your business or in the investment and they want to sue you, they have access to your assets. Okay, a partnership is just two people generally. It can be two entities, but we'll just use two people for example. Two people coming together, buying a property, going into business. Again, there's no protection because you're people and you're joint and severally liable now. So his problem is your problem and your problem is his problem in case you have problems outside of your partnership. And again, you have limited tax planning. A couple other structures are a company, which you do get a lot of tax benefits from, being a lower tax rate, and you have asset protection, being in the form of limited liability. So if you're trading in a company and something goes wrong, someone wants to sue you, generally they're only able to attack company assets. So if the company has no assets, it might be hard for them to get anything from you. But if you have assets and you're a director, as long as there's no other nonsense in between this situation, your personal assets should be relatively safe. There's another entity called a trust, which you can trade through and invest property through, which also has its own tax benefits and asset protection. So if you're looking to get into business and in property and all that kind of stuff, really it would, whether it's me or someone else, talk to an accountant, because they can run you through these different things. It can save you a lot of money in terms of losing assets to people you don't want to lose them to, and also save on taxes. So massive. It's very boring, but man, talk to me if you want help.
So for our listeners who are still awake, asset protection and tax minimisation is actually very, very important. I know I joke about it and talk about how boring it is, but it is actually very important, especially if you are a business owner. So, I've got plenty of asset protection strategies surrounding my portfolio. I've got multiple businesses. I'm always waiting to get sued, right? Because I'm saying something stupid on a podcast. So I have to be prepared for that.
Yep.
Now, that cost of protecting your assets, is it a tax deductible expense?
Well, the actual entities themselves generally aren't deductible, but they're not too expensive. So the cost of a company, for example, is a couple of grand, $2,000. It's generally a setup cost, not really a deductible expense, but that $2,000 can help save your home, right?
Yep.
So at the end of the day, it might not be deductible in most circumstances, but you're able to safeguard a lot of things with that $2,000.
And the distribution of the profits, for example, are very important through those structures as well, if you want to minimise your tax. So again, it's a very dry and boring sort of tip, but seek financial advice and accountant advice. If you want to know more about it, then obviously get in touch with us direct.
Something just quickly. I had a client come in, he had 150 grand, I think, from an inheritance, and he didn't know how to invest it, what to do. And I helped him set up a discretionary trust, a family trust. So he was going to invest it there just in case he was to be sued in his own name. He's a sole trader. He set up a trust that's investing all the money, and he's going to farm the profit to his wife that's not working. So if he makes 20 grand on these shares that he's investing in, instead of going to him and getting taxed hard in his business, it's going to go to the wife that doesn't earn any income, and it's also safeguarded against people trying to sue him.
And that's a great example, Sam, because a lot of people are about to walk into a lot of inheritances because of the great wealth transfer from the baby boomers to the millennials.
Yep.
It's happening in the next decade.
Yep.
So, it's important. If you enter into a windfall of cash, you are protected.
Yep.
My tip is, I love this one because I should be doing more, but donations to charity. They're basically 100% tax deductible if they're registered with the ATO, and most bigger charities are. And I think it's really important for all people, for when they become financially successful, to give back. I know we give back in other ways other than just money, through things like this podcast and education and all of that sort of thing. But when you're talking about money, it's a really good thing if you can find a charity that you really connect with. Put a percentage of your profits into that charity, because number one, it'll be a tax deductible expense, but you're doing good for the world.
That's right, and a good point you said. I've had a lot of clients over the years think they're giving to a charity, and sometimes if the charity or whatever the organisation isn't registered with the ATO, if they were to look at that, they might decline your contribution. So really, if you're looking, it's more for people making sizable donations. Smaller amounts, it won't affect you too much. You're not probably doing it for a tax deduction. But if you've come into a lot of money and you're contributing, say, 20 grand, I have had clients do that kind of thing. One, to be nice, to be charitable, but they also want to help reduce their tax. Make sure that organisation is a deductible gift recipient, DGR. You can look them up on the ATO. That just makes sure that you're thinking that you're going to get a tax deduction is true because they're registered there. And just so people know, if you're ever going to get a benefit from any type of charitable donation, like if you go to a charity auction and you're bidding on something, say like a jersey or something, generally speaking, if you get a benefit from the contribution, you're not supposed to get a deduction for it.
Yeah, right.
So it's purely like it's a giving of money to help the charity. It's not a a payment for a good or a service or anything like that. So just be careful.
A really good story is I had a friend who got really badly injured, and he was from he was let's just say he's from a very colourful world, right? And there was a lot of media attention on him. And he was in hospital for a while. He was really badly injured through a fight, and he was in hospital for a good amount of time. And what he had done was he donated a sizable amount to that hospital to say thank you. And it was I think it was like 50 or 60 grand. It was a good amount of money. And the papers picked that up, and they were like, wow, this guy's like an angel. Like, he's just gone and, donated all of this cash into this hospital for looking after him as a payment to say, a reward, right?
It's like a thank you.
A thank you, right? And but what was on the back of that was a massive tax deduction, and it reduced his tax bill. And I know he wasn't doing it purely for that, but it was a sort of a double whammy for him. You know what I mean?
Yeah. Well, I think if you're making more money, and those people generally have more money to give, so the ATO is actually going to reward you for your charity, which is a nice thing. So a good one to do if you're looking for another type of tax deduction.
Sam, you've got one more.
Another one to put you to sleep. Okay, this is going to put people to sleep. All right. So this just a couple of very quick points about some new changes. I'll run through ones applying to individuals first, not business people. Self-education, there used to be a threshold on how much you could claim.
What was the threshold?
$250. Well, just say if you did courses and stuff, if they didn't go over $250, they wouldn't claim the deduction.
Really?
Yeah. So you had to spend more than $250. They removed that. So whatever money you spend on education...
when did they remove that?
I think it was for 2021 this year, or 2022.
Wow.
I can't remember. But they removed that, so education, we always talk about education. If you do spend money in the course of increasing your knowledge in your field and things like that, it's deductible. You can get loans from the government called fee help loans, not HEX debt, fee help. If you get a fee help loan, which is usually for mature age students and things like that, not straight from school, they are actually deductible. So if you do a course that's eligible for fee help and the government gives you the 50 grand to do it, the 50 grand can be deductible. So there are ways that you can get educated at a tax deductible, in a tax deductible manner. And you're not spending your own money, you'll pay it back to the government over time. That's one thing. Some company tax changes are occurring with company tax rates dropping. But one big one, it might not apply to most people, but it is a big one in the tax space, more so for bigger businesses, is a loss carryback provision. And what that is since COVID, a lot of businesses would have struggled and they might have incurred a loss in 2020, 2021 to come. If that's occurred, you are able to use the loss that you've incurred now and apply it to a prior year's tax return, which is never really allowed. You're allowed to incur a loss and carry it forward. You're not usually allowed to incur a loss and carry it back. It's not usual practice. So if, for example, you had a business that made 150 grand in 2020, but with COVID and your business got smashed, and in 2021, you've now made a loss. That loss of 150 in 2021 could be applied to your profit in 2020, reducing that to zero, and you get a refund of your tax you previously paid. So, and there are some tricks in how to action
So it's just spreading it out, right? Like it's almost like you're trading that 2 years as one financial year.
Aggregating, yeah.
Yes.
Correct.
That's amalgamating.
That's a good way to do it. Yeah, so instead of one financial year, they're sort of giving you a 2 year window.
Yeah.
And what people
Which is very helpful.
Very helpful. And what people can do is take advantage of that instant asset write-off and buy some assets that are going to create a loss and then apply it to the prior year. So there are some tricks. If you want to know, just talk to us.
All right, my last tip.
Yes,
my last tip is just make more fucking money. Generate more profit.
Yes.
Right? Just like it sounds counterintuitive because we've said reduce your profit, so your tax bill is lower, increase your expenses, all of that sort of thing. But there is an upside to having a larger profit, and it just means you can grow. Right? Banks are going to loan you more money. Yeah. You can buy more property. You can do developments. You can invest in business. For our employee listeners, if you have ever dreamed of owning your own business, then, you can grow, right? And growth is what's going to get you ahead. Like achieving the 10-year acquisition strategy through being frugal and saving all your money, it's not going to work, right? Especially if you're over the age of 35. You've got to start thinking about growth. So my last tip is make more money.
Yeah.
Make more money, pay the tax bill, and you know what? Keep moving forward.
It's a balancing act. You don't want to reduce your income to the point where it stops you growing. You don't want to reduce your tax to the point where you can't grow. So that's the takeaway. So it's a balancing act.
All right, peoples. That's it. 10 tax tips before June 30. I hope you're still awake. We really thank you for listening. And Sam, thank you for your knowledge. You're a walking textbook.
No worries, mate.
I love it. Until next time, people, peace out.
See you.